We're the McLoughlin and Sommer team with Century 21 Redwood in Ashburn. Century 21 Redwood has an amazing in-house lender, Day One Mortgage. And today we're blessed to have Marla talking to us about 2-1 buy downs, which is a great alternative for some buyers in a tricky market.
So, what is a 2-1 buy down?
So thank you for having me.
You're welcome.
2-1 buy down is basically a temporary 2-year buy down for the interest rate.
So, how does that work exactly?
So let's give it a scenario. Assuming the buyer is buying a house in this market and their interest rate is 6%, with a temporary buy down, the first year interest rate will be 4%. The second year interest rate would be 5%, and the payment would be based on that low interest rate in the first 2 years. So it allows the buyer to afford the house in the first 2 years until they either refinance or they sell the house and buy a different house.
Okay.
Or get a raise,
Or
right?
get a raise. Right, exactly.
Right.
What, so is there a cost to this?
Yes, so there is a cost, and think about it from a lender perspective. The lender is getting less interest, that's how they get paid, less interest in the first 2 years. And because they're getting less interest, there's a fee to offset that cost. That fee is called a buy down subsidy. It's paid by the seller. We recommended that the buyer request the seller credit for it. It's different, so it changes with the interest rate, it changes. So it is always we always recommended that the buyer connect with the lender to find out how much is that amount for, but as a general rule, it's about 2%.
Okay. So how exactly does it work at the end of that 2 years? What happens?
So at the end of the second year, the buyer by now is going to turn into the 30-year fixed rate, which is whatever rate they were locked in. In our scenario, it would be the 6% interest rate.
Okay. And so it just jumps to the 6%. It's not like a balloon payment or anything like that.
No.
It's just
Or an arm, yeah. It's
it
not
just-
like that. It's much safer, right?
It is, because they are locked into that rate for 30 years unless they refinance.
Right.
They just get a break the first 2 years to allow them to settle in, like I mentioned. Based on the statistics, any employee who stays with their current employers, they get a raise of about 7% a year. So we're talking 14% in the first 2 years. That would allow them to be more comfortable with the payment when it increases in the third year. But they know what it will be.
Right.
So they have an idea of how much it will be. The best part about the buy down, if the rates drop, they can refinance,
right.
and whatever left over from that from the buy down subsidy, they can get that money back.
Oh, nice.
Wow, that's great.
Yes, and they can use that for the refinance cost to pay the closing cost for it. So it helped them in both ways.
That sounds like a great alternative for some buyers. Are you seeing a lot of 2-1 buy downs?
That's all we're seeing now.
Right, right, yeah.
Do the buyers, though, have to qualify for in this case, we talked about 6%. So they have to qualify for 6%,
Yes.
correct? Not the lower rate. Okay.
Yes, to comply with the ability to repay the mortgage rule, we have to qualify them based on the interest rate that they're locked in, the fixed interest rate. It's the same for the adjustable rate mortgage. They have to qualify for the interest rate when it changes, not for the introduction rate.
Right. Got
Right.
it. Got it.
Terrific. Wow, well, thank you so much for that information. If you have any loan-related questions, get in touch with Ro and I, and we will definitely put you in touch with Marla. She's a tremendous help. Thanks for being with us, Marla.
Thank you for having me.